For 3 decades, technology always wins. Investors have been conditioned to believe that when uncertainty rises, when growth slows, when rates fall, or when innovation accelerates, capital inevitably flows into technology stocks. And for long stretches of time, that belief has been rewarded. But markets do not reward narratives forever. They reward constraint, they punish exhaustion, and today's chart reveals a constraint that almost no one is talking about. This is not a valuation chart. This is not a rates chart. This is not an earnings chart. This is a liquidity chart. And it asks a dangerous question. What happens to tech leadership when corporate cash stops expanding? So how to read this chart? There are two lines, two vertical axes, left and right. The blue line measures on the left axis represents the S&P 500 information technology sector relative to total return index. This is not absolute performance. This tells us whether technology stocks are outperforming or underperforming the broader S&P 500. The red line measures the red line, so we're talking about the blue line, right? So we're overperforming, and the red line measure on risk access represent the total U.S. corporate cash as a percent of GDP. So the red is cash, the blue is the tech stocks. This is system internal fuel supply. It reflects retained earnings, balance sheet liquidity, and corporate financial optionality. So time runs from 1990 on the left to 2026 on the right. When these two lines rise together, tech leadership is being supported by expanding corporate liquidity. You could see it. All the money is being spent on AI, right? When they diverge, something breaks. So let's take a look at the first line, right? The peak on the left and the peak right in 1999. Of course, this is a dot-com era. Corporate cash as a share of GDP surged before the tech's dominance peak. Right? Look at the red line. The red line started going up first. 1996, and then the blue line catch up, but the red line was always above. This is critical. Corporate cash as a share of GDP surged before tech dominance. That matters. The red line accelerates upward through the mid to late 90s, which provide the oxygen for aggressive capital spending, speculative equity issuance, venture expansion. The blue line followed, but look carefully at what happens next. Around 2000, corporate cash peaks. Is a red line? It starts dropping. The blue line collapsed shortly after. It's not coincidence. This is causality. When corporate liquidity stopped expanding, tech lost its margin for error. The market didn't crash because valuations were high. It crashed because the cash buffer vanished. Gone. From 2002 to 2012, something remarkable happened. Now look, 2002, right? The red line, the blue line, which is index, drops even further down the cash, way down. Corporate cash remained elevated relative to GDP, but tech leadership never regained dominance. Why? Because liquidity alone is not enough. After a crash, capital becomes conservative. Cash is hoarded. Balance sheets are repaired. Risk appetite is suppressed. This is a hangover phase. You've got the cash. You just don't want to spend it. Now shift your eyes to the period after 2012. We're about in the middle of the chart here. Look at what's happening. Corporate cash rises again, but this time the source is different. It's not productivity, not organic growth, it's monetary expansion. Zero interest rates, quantitative easing, debt-funded buyback. Tech leadership returns violently. The blue line climbs steadily, then accelerate post-2020. You see that? But once again, look at the red line. It peaks. And then it starts to wobble. The red line is the cash. And here's a critical question investors are refusing to ask. Can technology continue to outperform if corporate cash stops growing relative to GDP? Because that is what's happening right now. The red line is now below for the first time. Well, it was below shortly before the crash of 2000. It's now way, in fact, it's way below actually. Look at this, the spread between the red line, which is the cash, and the blue line, which is the index, the tech index. It's the widest it has ever been, where the cash is below. So now tech dominance is not just about innovation, it's about tolerance for unprofitable growth, capital intensive AI build outs, acquisition premiums, employee compensation leverage. All of those require excess liquidity. If corporate cash flattens, or worse, contracts, tech leadership does not gently fade. It reprices. So what is the modern danger? Well, look at the right side of the chart. Technology relative performance is near historic highs. Corporate cash is no longer accelerating. This is not a crash call. This is a fragility warning. When leadership becomes dependent on liquidity expansion rather than productivity expansion, becomes vulnerable to higher rates, fiscal crowding out, wage pressure, capex competition, geopolitical supply shocks. Leadership doesn't disappear, it rotates. So every tech cycle ends the same way. Not with bad news, not with earnings misses, not with regulation. It ends when the cash stops growing. This chart is not predicting collapse, it's identifying the limit of comfort. And history is brutally consistent about what happens next.